Good evening, everyone. This is Melissa Hunt with Credit Union Student Choice. Thank you for joining us tonight for College Financing 101, Understanding Your Award Letter. Now, you were invited to this webinar tonight because your credit union has partnered with Student Choice to offer affordable, responsible college financing solutions to you with low rates, flexible terms, and zero origination fees. But the purpose of this webinar is really for us to go through and understand how not to borrow. But again, your credit union has partnered with Credit Union Student Choice to help you navigate through the process and understand the best way to get through this process and hopefully get through financing your education with as little debt as possible. Now, one thing to remember, and we'll talk about this as we get closer to the end, is each credit union has partnered with Student Choice. They all set their own rates and limits, so please be sure to visit your credit union's website for more specific information about your particular credit union's products that they offer. Please note that all lines have been muted as we move through this process, so we will not be able to accept questions during the presentation. And the biggest reason for this is we have over 300 attendees joining us tonight, and if we allowed everyone to ask questions, we could potentially be on the phone for several hours. So we're going to ask any questions or comments that you might have about today's presentation be sent to scholarhelp@studentchoice.org, or you visit the Student Choice website directly, and it'll lead you through to the Scholar Help area of our website where you can submit any types of questions that you have about tonight's presentation around financial aid or higher education in general. So with that, let's go ahead and get started. On our agenda first, we're going to talk about some various definitions that you may run across as you're navigating through this process. Then we're going to talk about different types of financial aid that you may see listed or available to you through your award letter. We're going to go through a sample award letter. We're going to talk about how much do you really need to borrow as compared to what's on your award letter. We'll talk about the ways that you can appeal your award letter and if you should appeal your award letter and exactly what appealing your award letter means. We're going to talk about private loan options, and then, of course, we're going to send you right back to your credit union so that your credit union can help you navigate through this process. So first, let's go ahead and talk about definitions. So what exactly is an award letter? An award letter is also referred to as a financial aid package. This financial aid package contains the cost of attendance at the particular school that you'll be attending, along with any other type of financial aid that's being offered to the student. And we will talk about types of financial aids on the next screen. On your award letter, again, it should contain the cost of attendance, also referred to as COA. It's important to understand that the cost of attendance is set by the school. So each school will set their own cost of attendance, and it's there to cover the student's expenses. So this would include tuition, fees, books, food, miscellaneous expenses, rent. Some schools will include a cost for laptops. If you are a parent, some schools may include costs for dependent care while you attend school. So again, each school will set their own cost of attendance, and it's basically the cost that the school states the student needs to go to school and have their expenses covered. And then the third definition we need to review before we move forward is financial aid. And financial aid is the offering of any types of scholarships, grants, federal money, or loans that are made available to assist the student in meeting their cost of attendance. So again, the award letter contains information about financial aid that you will receive as well as your cost of attendance. So let's talk about different types of financial aid. We've got scholarships and grants, federal work-study money, federal Perkins loans, federal direct loans, and then parent loans for an undergraduate student. So there's several types here, and we're going to talk about each of them separately because some of them, all of them, or a combination of could be listed on your award letter. So it's important that you understand what each type of these aids mean. So scholarships and grants, this is considered free money, and it comes from the government, the state, or the school. Money that comes from the government is typically consistent each year in the type of programs that they offer. Money from the state could change each year, and it could vary from state to state, as well as money made available from the school. Typically, scholarships and grants, they will not have to be repaid, but it's important to understand before accepting any type of quote-unquote free money that there could be an obligation associated with accepting that particular free money. And so if you fail to meet that obligation, you may have to pay that money back. So again, on your award letter, you could have scholarships and or grants listed. You have the ability to accept or decline these scholarships or grants, and it's important to understand that there might be an obligation tied to accepting that money, and you have to be willing to meet that obligation, or you may have to pay back that particular type of money that is being offered to you. Now, scholarships and grants are awarded for a variety of reasons. They can be based on need or merit, academics, sports, extracurricular activities. Again, there's just a number of reasons why scholarships and grants could be awarded, and you want to make sure that if there's a condition tied to accepting that free money, that you're willing to meet that particular condition that's tied to it, or you may have to pay it back. The other thing that you're going to want to explore is the scholarship or grant renewable. So this is really important whenever you're comparing award letters. So you could potentially have two award letters, and one award letter may list a $5,000 scholarship, where another one may list a $3,000 scholarship. So our immediate impulse would be to accept the award letter that has the $5,000 scholarship. However, if the $5,000 scholarship is not renewable, which means you won't be able to get it in year 2, 3, and 4, but the $3,000 scholarship is renewable, then $3,000 over a 4-year period is now worth $12,000 to you versus $5,000 over a 1-year period. So again, when looking at scholarships and grants, be sure that you're willing to meet the requirements attached to receiving that aid. Find out if it's renewable, and compare your award letter so that you know exactly that you are comparing apples to apples. The next type of money we're going to talk about that could be listed on your award letter is the Federal Work-Study Program money. And we refer to this as free money, kind of, because it's money that's going to be awarded to students on a first-come, first-served financial need basis, and the students are actually going to earn money while they're in school to help them meet their financial needs. So it's not really free money in that it's given to the student, but it's money that does not have to be paid back and that the student can earn while they're in school to help them meet the financial need of or their financial obligations while attending college. These jobs are paid at least minimum wage. They're usually part-time, and they're usually on campus. And I always recommend that if you have the opportunity to work through the Federal Work-Study Program, that you definitely take that opportunity. And there's a number of reasons, but one of my biggest reasons is that because most of these jobs are on campus or directly off campus with an organization that the school might have a relationship with, the good thing about the Federal Work-Study Program is that they'll definitely work with your schedule. So there's an opportunity to have your work schedule altered around your school schedule, so you don't have to worry about being out waiting on tables until 2 o'clock in the morning and then getting up for an 8 a.m. class. So I definitely recommend that if the opportunity to work through the Federal Work-Study Program is presented, that you take that opportunity. The other thing I want to talk about for a moment is if you request to be a part of the Federal Work-Study Program and it was not awarded to you on your award letter, it doesn't necessarily mean that there's no more jobs on campus. It just means in most cases, or in almost all cases, that the money available through the Federal Work-Study Program at that school has ran out. But again, it doesn't mean that the jobs are not available. So if you really want to work while you're in school, and you did request to participate in the Federal Work-Study Program, and it was not listed on your award letter, I would highly recommend that you go to the financial aid office or admissions office and ask them about other types of jobs available on campus that you can work through to help meet your financial needs. So the next type of money that could be listed on your award letter are loans. And the first loan that we're going to talk about is the Federal Perkins Loan. This loan is in the student's name, and it's made directly through the school's financial aid office. It's awarded to students with exceptional financial need. So the school will define the exceptional financial need, and the maximum amount that any one student can receive is $5,500. Now, while the student is in school, the government pays the interest on this loan for the student. When the student separates from the school, there's an interest rate of 5% fixed tied to this loan. There's no origination fee tied to it, and once the student is in repayment, they pay the money back directly to the school over a period of 10 years. Now, I have down here on my last bullet point that the grace period is 9 months. And the reason that that's kind of important for us to talk about is because most student loans and government Stafford loans, the grace period is 6 months. With the Federal Perkins loan, there's a 9-month grace period. And what that means is up to 9 months after the student separates from the school, they do not have to make any payments on this loan. So it gives them a little longer than the standard 6-month grace period before they go into repayment on the Federal Perkins loan. The next loan that could be listed on their award letter is a federal direct loan. This is also sometimes referred to as the Stafford loan. And these loans are in the student's name, and they come directly from the U.S. Department of Education. Standard repayment terms on these loans is 10 years, and again, it has a 6-month grace period tied to it. Now, there's 2 types of loans that the student can receive. One's unsubsidized, and the other is subsidized. Unsubsidized money is awarded to all eligible students, and it is not based on need. So there's criteria that the student needs to meet to qualify for this loan, but almost all students qualify for this loan. So if you're a U.S. citizen, if you've graduated from high school, if you're enrolled in a degree-seeking program, that's pretty much the high-level overview of everyone that receives the loan. So 99.9% of people, I would say, if not even higher, will receive an unsubsidized loan from the government. Okay? These loans, again, are in the student's name. They are not credit-based. The student does not have to have a job. There's no cosigner on these loans. They are 100% in the student's name, no credit, no employment, and they're given to the student as an opportunity to help them fund their education. The students are responsible for the interest. However, while they're in school, they can defer the interest. And defer means they're not paying anything on this loan as long as they're enrolled in school at least half time in a degree-seeking program. Now, the interest does not capitalize until they go in repayment, which means it does sit in a separate bucket, so you don't necessarily have to worry about interest on interest on interest accumulating each month. So while they're in school, the interest is deferred. It does not capitalize until repayment. And when they go in repayment, then they have a 10-year repayment term. The interest rate on the unsubsidized loan is 6.8% and a 1% loan fee. The other type of loan available is the subsidized loan. Now, the subsidized loan is awarded to eligible students, and this is based on financial needs. So not everyone's going to qualify for the subsidized loan. And the cool thing about the subsidized loan is while the student's in school, the government pays that 6.8% interest rate for them, so no interest is accumulating. Once they separate from the school, there's this standard 6-month grace period, and then they will start paying back the loan at 6.8%. So now that we've talked about the different types of money that could be listed on your award letter, let's go ahead and talk about a sample award letter. So this is just a general idea of what an award letter could look like. All schools will send an award letter to the families, and then they will send them in different types of forms. They'll send them in email format. They'll send them in mail format. There's just different ways that the school will send them, and you need to check with your school to find out exactly how you receive your award letter. Now, also, these award letters, as far as the format of the award letters, they're going to look different, but then oftentimes they'll look very similar. But most of the time, they're going to pretty much be standard, where the top of the award letter will discuss the cost of attendance, which we've already talked about, and then it will list any type of financial aid that the student's going to receive, and then it will list your remaining need. Okay, so on this sample award letter, this student received $3,500 in subsidized money, $2,000 in unsubsidized money, so this is the government loans from the schools. They received a school grant for $1,500, a state scholarship for $1,000, and then the federal work study program for $2,000. So this student's total award was $10,000. At this particular school, the cost of attendance was $20,138. So the remaining need for this family for this academic year is $10,000. Now, this could potentially be what the student needs to borrow or the families need to borrow to help them pay for school. And I know that probably scares a lot of you out there, so I do want to talk for one moment about student indebtedness. And we know that there's been a lot of reports in the media, specifically over the last 6 to 8 months, about the widespread student debt crisis that's really discouraging to families and really make them take a step back and consider exactly how they're going to finance their education and not wanting to borrow. But in reality, we really want to share with you some statistics around the type of debt that students separate from school with. And if you look at the PowerPoint and you look at the wheel, you're basically looking at 73% of students that separate from school with less than $25,000 debt. And again, a lot of the stories that we hear are sensational stories around students having $100,000 in debt and $150,000 in debt. And if you look at the wheel, you'll see that only 1.2% of students that separate from school have debt of $150,000 or greater. And then just under 5% at $75,000 to $150,000. So hopefully that eases your mind a little bit to know that 3 out of 4 students actually separate from school with less than $25,000 debt. So let's figure out how to not borrow and figure out how much do I really need so that I'm one of those students that have the least amount of debt as possible. So whenever you're looking at your award letter and you're considering the types of financial aid that have been offered to you and what your overall need is, you definitely want to consider your fixed costs, your flexible costs, other income that may be available to you, and then in some instances you may have a case to appeal your award letter and potentially get more money through financial aid. All right? So first, let's go ahead and start with fixed costs. When you're looking at your award letter, and the cost of attendance in our example a few slides back was a little over $20,000. There's only 2 things that are truly a fixed cost. So the school stated you needed $20,000 to go to school. But in reality of that $20,000, only 2 of those items are fixed costs, and that's tuition and school fees. Now, on average, an in-school, not-for-profit 4-year state university, their tuition is going to be about 40% of their cost of attendance. So in this case, $8,000 of the cost of attendance. And then school fees. School fees are fixed costs. So in our example, your fixed costs are $9,000. So that means that the school's allotting another $11,000 to pay for other things like rent, food, books, miscellaneous expenses. So $11,000 is being allowed to pay for all of those other expenses, which we refer to as flexible costs. So whenever you're looking at your flexible costs, what you really want to do is you want to sit down with your family and talk about how much money do you need to work through your academic year. So the school may be allotting you $550 a month for rent, but maybe you're able to share an apartment with a friend and your portion is only $400. So instead of needing $550 a month, you only need $400 a month. So you've just knocked $1,500 off your overall cost of attendance. Food. The school might be allotting a specific amount for food where you know your food budget is going to be X times 10 months. Books. The school, in your cost of attendance, is always going to allow you the cost for new books. If you simply purchased used books or enter into a book sharing program, you're automatically going to cut money off of that cost of attendance from the school. But in this particular example, we want to look at all of our costs so we can really look at where we can shave back various costs within our attendance. So again, what you want to do is you want to sit down, you want to list out your fixed costs, and then as a family, you want to navigate through your flexible costs, all right? And everyone's flexible costs are going to be different. But again, I promise you, if you just sit down and you look at your book cost and you buy used books instead of new books, you're going to cut your cost of attendance. But you want to sit down and you want to look through all of your various expenses that you have and come up with your own flexible costs. So in our example, our fixed cost was $9,000. Our flexible cost was $8,750. So our total cost that we need to attend university is $17,750. The award package that we were receiving was $10,000. So our overall need is only $7,750. And if you remember in our example, we started out needing $10,138. So just by sitting down and going through our own budget, we were able to reduce our need by over $2,300, which of course equates to borrowing $2,300 less. So it's just really important that you sit down and you go through your own budget. You figure out exactly what you need over that 10-month academic period. And then in this case, let's say we need that $7,750, so $775 a month. So how can we keep from borrowing $7,750 a month? We can consider other income to help net against our monthly expenses, right? Maybe Grandma and Grandpa is willing to assist and send $25 or $50 a month. That helps, again, decrease the overall annual amount that you need. Then also, some schools will offer school payment plans in lieu of borrowing. So you may end up needing a total of $7,000 for the entire academic year. Some schools may offer an opportunity for you to just pay $700 a month over a 10-month period, or in this case, $775 a month for a very small fee. So remember, the ultimate goal here is for you to borrow as little or none as possible. So you definitely want to go through your budget, consider other income, potential part-time income, and then talk with the school if there's any types of payment plans available. So now, as you walk through your award letter and you go through your budget and you figure out exactly how much your family needs, you may still feel that you just can't make it work. And you may still feel that you really did not receive the type of aid that you believe your family could utilize. And so in this situation, you could potentially appeal your award letter. And the reasons that families appeal their award letter is that basically if anything has changed in your family situation that you feel was not accurately reflected in your free application for federal student aid or your college application information that was provided, then you would definitely want to appeal your award letter. So if there was a change in employment or income since those documents were completed, if you have excessive medical bills, if a divorce was coming into play or a disability or death, or if there's really high consumer debt and there was nowhere to really notate it through that initial process, then you could potentially approach your school about appealing your award letter. Now, appealing your award letter just simply means that you're going to talk to your school through whatever process that they want to talk to you through, and together the school and the family can figure out if there's something more that the school is able to do to help the families meet their actual needs that they have and that gap between what they originally received on their award letter and what they're able to do. So again, just remember that each school is going to have their very own process. Some schools might require you to make an appointment and come in and sit down and talk with someone. Some schools might just ask that you write them a letter and explain your circumstances. Others may actually do a telephone interview with you. So again, every single school is going to go through their own process, and it's important that you reach out to the school and you figure out exactly what their process is. So after we go through all of this process, examining our award letter, deciding what to accept or decline, potentially appealing our award letter, going through our budget, at the very end of the day, we may still end up with a remaining need. And so this is where we figure out where is that remaining need going to come from. Are we going to borrow it through student loans? Are we going to use 401k? Are we going to dip into a savings account or maybe take out a home equity loan? And so this is where it becomes a really personal decision where the family has to make the best decision for the family. No one can make this decision for you. For some families, they may want to exercise their 401k plan to pay for education. Other families, the better decision might be taking out a home equity loan. And then still, some families might choose private loan options. For the purpose of this webinar, we're only going to focus on the student loan option. The first student loan option that I want to talk about is actually a parent loan. It is a parent loan for undergraduate students, so referred to as the PLUS. It is a government loan, and it is a credit-based loan made to the biological, adoptive, or in some case, step-parents of a dependent student. And it's there simply to meet that remaining need that the family has to fund the education. The interest rate on the loan is 7.9% fixed interest rate, and there's a 4% origination fee tied to this loan. Now, the most that the parent can borrow is the cost of attendance less any financial aid. So if the cost of attendance is $20,000 and the student received $7,000, the most that the parent can borrow is $13,000. Payments begin on this loan 60 days after the first date of disbursement, of the final disbursement for the year. So if your young adult is a freshman in college and you take advantage of the parent loan for undergraduate students, there will typically be 2 disbursements, one in the fall, one in the spring. So let's say you borrow $10,000, $5,000 will go in the fall, the remaining $5,000 will go in the spring. 60 days after that final disbursement, you'll begin making payments on the parent loan for undergraduate students. Now, I will tell you, if you take advantage of the parent loan for undergraduate students, you do have an opportunity to request full deferment until your young adult separates from school. However, if you do not request it up front, they cannot go back and put it into that deferment status. So it's really important that you make a note somewhere that if you take advantage of the parent loan for undergraduate students, if you want the loan to be deferred while they're in school, you must request it up front before the disbursement. So make sure that you make a note of that, again, if you plan on deferring the loan. So there are no prepayment penalties on paying back this loan, and any dependent student whose parent is denied the parent loan for undergraduate students, they do have an opportunity to go back and get an additional amount in those federal direct loan limits that we talked about earlier. Now, outside of the parent loan for undergraduate students, there's another alternative, and that is a private loan option. It's really important that we understand when borrowing through a private student loan that there are many factors we need to consider before making a final decision. So what we're going to talk about now are some of those things to consider. And again, at the end, we will supply to you an email address or the website where you can submit any questions. But in my opinion, as we go through this webinar, this is one of the most important slides of the webinar, because once you get to it, down to it, and you really have to borrow to pay for school, you really want to borrow smart. So it's really important that you understand how private student loans work. And again, if you have any questions, you're more than welcome to email us, and we will connect with you and help you navigate through this process. So when you're looking at private student loans, one of the very first things you want to consider is the rate. What rate is being used? And in the student lending world, there's typically 2 indexes that the student loans are priced off of. One is prime and one is LIBOR. So when a lender shares their rate or expresses their rate to you, the consumer, they will list it as the index plus a percentage or the margin. So I might say to you, my student loan rate is prime plus 4%. And what this means is you're going to pay the prime rate, which is currently 3.25%, plus 4%. So your rate will be 7.25%. Or as a lender, I could express it as LIBOR plus 4%. LIBOR is currently, I believe, at 0.21. So if I'm telling you LIBOR plus 4%, your rate's going to be 4.21%. So this is why it's really important that you understand what index is being used, because typically prime runs about 3% higher than LIBOR. But that doesn't always mean that that LIBOR is the better rate, because I could tell you prime plus 1, which would put your loan at 4.25%, or I could tell you LIBOR plus 7, which puts your loan at 7.21%. So again, it's just important that you do understand what index is being used, prime or LIBOR. And then next, what is the percentage that's being added to that index? So prime plus 4, prime plus 5, LIBOR plus 2. And then finally, what's the floor rate? So again, as a lender, I could tell you my rate is prime plus 2 with a floor of 8. And what this means to you is that your rate is going to be 3.25% plus 2%, which is 5.25%, but my floor is 8. And so what that means is that your rate will never go below 8%. And I do realize that for some of you on the line that this might be a a little foreign to you if you've never worked in this type of loan options. So I apologize for those of you who understand it, and for me to continue to talk about it. I just want to make sure everyone does understand that these loans, again, are priced off of an index with a margin and a floor. So if you have any further questions about how the rates are set, again, feel free to email us. The next thing you want to ask about are fees. Some lenders will tie a fee to their loan. So if you borrow $10,000 and they charge you a 1% fee, you're going to pay $100 for that loan. So it's important that you understand if the lender has a fee tied to their loan. Also, repayment terms. Some repayment terms are as low as 10 years, while others go up to 25 years. This is important to understand because if you are a family that borrows $10,000 a year each year, when your young adult separates from school, you could potentially have $40,000 in debt. So are you willing and able to pay back that $40,000 over a 10-year period, or do you need a loan that's going to give you a longer repayment term? And these are things that you've got to answer up front before you sign your promissory note. So again, these are things that you want to consider as a family, and then you want to ask the lender as you go through the process of borrowing for higher education. You also want to find out about borrower benefits, the whole what's in it for me, right? WIFM, that's everyone's favorite radio station. What's in it for me? Many lenders will advertise various borrower benefits. So it's really important that you understand what those borrower benefits are, what you have to do to receive those benefits, but almost more importantly than receiving them, what could you potentially do that could cause you to lose that borrower benefit? So again, on the front end, a lender could be advertising a borrower benefit of 2% rebate for good grades or for exemplary grades. So to get that borrower benefit, there may be steps that you have to go through several times a year to continue to qualify for that benefit. So you might want to ask the lender exactly how do I qualify for this and what could happen that could cause me to lose this benefit. Also, co-borrower options. Many of these student loans are going to need a co-borrower because most lenders will not give a student with no employment history, no credit score, and no monthly income an unsecured private student loan. So most of them are going to need a co-borrower. So when you're talking to lenders about co-borrower options, you'll want to find out what the lender takes into consideration when they're pricing the loan. So are they looking at FICO scores, debt-to-income ratios? Are they simply just looking at income? Is it tiered based on various FICO scores? And the reason that you want to ask about this is if you have more than one qualifying adult willing to be the co-borrower for the student, then you'll want to use the qualifying adult that's going to get you the lowest interest rate. And then the final thing that you want to consider when you're looking for a private student loan option is what are my payment options with this loan? Can I put this loan in full deferment while I'm in school? Do I have to pay principal and interest while my young adult's in school? Or do I have good faith payments that have to be made? And every lender is going to be different. Some will allow you to have the entire loan in full deferment, which means you're not paying anything while the young adult's in school. So full deferment, interest does accrue, but it doesn't capitalize until repayment. If you're required to make principal and interest payments, then it'll be like a regular loan payment that you're making every month right after your young adult starts school. Or again, some lenders may require a good faith payment, and those good faith payments can be anywhere from $25 to $50 a month, or it may be that you're just making the interest payments every month. But again, you want to ask so that you're prepared to make those payments at the time that the payments become due. Now, for many of us on the line who are parents, we may recall when we went to school, it was across the board that you could put your loan in deferment. There was never even a question about it. That's just how it operated. You could put your loan in deferment. It was no big deal at all. But again, that's not the case anymore. Some lenders do require that you make good faith payments. Some might require that you make full principal and interest payments, while others still do offer the full deferment option. So you always want to explore and research all of your options so that you can make the best choice for your family situation. And again, Everyone's decisions are going to be a little different just based specifically on your situation. Now, with nearly 250 credit union partners across the country, we know the student choice solution that we have available to help you finance higher education is a great solution, because this product was created by credit unions to help credit union members fund higher education. So we know that we have a really great opportunity to help families who need to borrow, but it's also important that you understand part of the reason we're having this webinar tonight, part of the reason that your credit union participates with Credit Union Student Choice is simply because their overall goal is to get you through this process educated so that you have as little debt as possible. But if you do have to borrow, we want you to borrow wisely. So each credit union, they're each going to have their own unique rates and a maximum loan amount. So you'll need to visit your credit union's website for more information about your specific credit union's information. But I will tell you that on average, the credit union student choice loan rates are right around 6%, where the industry rates are above 9%. So again, this is just another indicator to you that your credit union is truly looking to do what's best for you, what's in your best interest and for your family. But their ultimate goal is for you to go through this process and borrow as little as possible. But again, if you do have to borrow, your credit union does have a solution, and the repayment terms are 20 to 25 years. And you can have full deferment while you're in school. We have a graduated repayment option available for families, which basically means when the young adult separates from the school, their payments are going to be less for the first 2 years than they would be over the remaining term of the loan. And this kind of gives the young adult a chance to get out of school and to get on their feet and get their career going before they go into full payments. And then we also have a 25 basis point rate discount if automatic payments are made. So we have over right about 2,000 schools that we lend to on behalf of you to help you fund this education. But again, please know that the ultimate goal is for you to understand the process, for you to understand exactly what cost of attendance means, understand what's being offered to you on your award letter through financial aid, and then budgeting. You want to go through your budgeting process so that you have as little need as possible. If appealing your award letter is something that applies to your family, you'll want to appeal your award letter to, again, decrease that actual need that you may have to borrow. And then if you have to borrow, you want to make sure that you understand all the questions to ask as you go through that process so that you can make the best decision for you and your family. So please make sure you visit your credit union's website or www.studentchoice.org for any additional information. And we definitely want to thank you tonight for spending the evening with us, and hopefully you learned a little more about your award letter and how to navigate through that process. And please feel free to submit any questions directly to us at scholarhelp@studentchoice.org, or you can go through our website and visit the Scholar Help portion of the website to submit your question. We have financial aid professionals on staff that have worked in every different aspect of financial aid, from the financial aid office all the way through funding and in admission offices as well. So we're here to help you navigate through this process. So again, thank you for joining us this evening, and please feel free to reach directly out to us with any questions or additional information you may need.